I would do potentially more work and better work than the next person. That next person would get a promotion. I wouldn't. I'm a very principled person, and the principle of fairness was just killing me.
Welcome back, investor. We're so glad to have you for another episode of the Passive Income Adventures. And today I am like a little girl, so excited to see that we have Jeremy Roll on the show. So I go over with Jeremy in our intro how we met, and really it was part of what he was teaching that really changed my attitude about passive income. I had been wanting to be an active investor because my husband was working and I felt like I needed something to keep me busy. And we also didn't have enough money that if we invested it that it would replace his income. And so we were trying to figure out the best way to generate more income. And so we got into active real estate investing and apartment syndication. And sitting in Jeremy's talk really made me take a step back and ask myself, what am I doing? And this thought dogged me over the next couple of years of syndication, getting sucked into that, to the business. And so I love the discussion that Jeremy and I have with how to decide what is your personality type. Can you handle a business, or are you more of an investor? Can you handle giving up control to be a passive investor? Do you need more control to be a little bit more hands-on? And so asking yourself a lot of these personality questions is really important, because this isn't for everyone, and it might be for you and it might not be for you. And so the people that we're trying to talk to and the people we're trying to reach, trying to tailor a fund and a club that is really what you are looking for. And if it's not what you're looking for, somebody else out there is offering it. And so we want to make sure we put a lot of people in front of you so that you can ask yourself all of these kinds of questions, figure out what your goals are. You may not even know, if you're at the beginning of your journey, what questions to even ask. And so going through this process and talking to a lot of different people, like listening to them on the podcast and then reaching out afterwards, will help you zero in on what it is that you're looking for that's going to meet your needs. And so this discussion with Jeremy, it runs a little bit long because honestly, I selfishly had him to myself for a while, and I wanted to ask him a lot of questions that were specific to our situation. And so I think in a way that having him answer those helps you to get to know me a little bit better, but also helps you to get to know Jeremy a little bit better, because we're able to get into some really specific nitty gritty stuff that may or may not apply to you. But I think it's really important to know the people that you're networking with. And hopefully this episode will give you a little bit more of a glimpse into how we work, what we're looking for, and basically how we've made the decisions on our own passive income adventure. So coming up, Jeremy Roll. Hey, Jeremy, I'm so excited to be interviewing you today. I think the very first, I went to a capital raising conference like back in 2019 before I ever bought my first commercial real estate project, and you were speaking, and it was a presentation along the lines of what every passive investor should know. And as you were talking, I was sitting there watching, thinking, oh, these are great things that I should put in my pitch deck so that when I'm talking to my investors, I know what they want, what they're interested in. But by the end of the presentation, I had my first deal under contract. We hadn't even closed on it yet, but I was just sitting there like, wait a second, why am I not just a passive investor? It just sounded like so much more in line with the questions I was asking myself. And so since that time, I've been following your work and following your content and just feeling like this is somebody who is on the road that I want to be on, and you finding those role models and figuring out who you want to follow. And you've definitely been a source of that for me. So I'm just really excited to get you all to myself for an hour and ask you all the questions. So thank you for coming on the show.
Absolutely. No, thank you for having me here. Really, all I care about is just as helpful for whoever's listening to this, and maybe for you as well for whatever questions. But I'm glad I've been helpful so far.
Yeah, that's one thing that is really interesting to me that we were talking about beforehand, is that most of the people who come on the show are still in the entrepreneurial hustle and grind. And you're a very busy guy. We talked once a couple months ago and you told me that you are working harder now than you ever have in your life, like spending more time, but it's time that you want to spend, and it looks very different than time that you have to spend. And so your motivations really seem to be altruistic, where you just want to get the word out there that this is a great thing to be building wealth and paying it forward and just hoping that people get value out of it. There's really nothing to sell. I even asked you that. Okay, so where should I go after this? And you're like, no, just ask me questions. I just want to be helpful. And so I think that that is what really sets you apart. And people who've already gotten that passive income is greater than their monthly expenses. Once they get to that point, there seems to be this abundance of wanting to give back. So that, I don't know, how well does that describe you?
That is true. I really just feel lucky that I got to this point, and I have a lot of calls with people who are brand new to the space or just trying to brainstorm. I just had a call this morning, a couple of probably an hour or two ago, with actually a sponsor who was trying to help me to brainstorm his structure. And that's also, I never charge anybody anything just because I figure it's helpful, it's good to network, etc. So any way I can help, this is how I've realized I can kind of give back with time. And so that's why I do a lot of that. And it's actually all the time that I use to give back is what makes me so busy, to be totally honest with you. I mean, I'm always networking to find opportunities, but if I got rid of all those calls, I wouldn't be doing work at night. But it's great. I'm just very lucky I'm in this position and happy to help.
Yeah, so let's jump back into your past just a little bit, like where you started and how you got to where you are. So your background at Disney and starting to be a passive investor, and just walk us back a little bit and share with us some of the experiences that you had where you just got to points in your life where you're like, I'm just need to do something different than I've everybody else is doing or that I've always been doing.
Yeah. Okay. Well, this is gonna hopefully there's old enough people here to even relate to some of this. So a couple of things. First of all, I was working in the corporate world for over a decade. I got an MBA from the Wharton School from University of Pennsylvania. I was on a typical corporate track. I was kind of middle level management at that point in corporate America. And after the dot com crash, so actually, let me not get to that. That's actually the investing side of things. Let me get to the personal side of things. I literally sat behind desks in really good jobs. I mean, my last two jobs were at Toyota headquarters. That was my last one in Los Angeles. I was working across like Toyota, Lexus, and Scion vehicles. I'm a car guy. Great job. My previous job, I was at Disney for several years at their headquarters in Burbank, working on DVD and VHS for anyone who's old enough across like amazing brands. We're talking like Disney, Pixar, Miramax, ABC, ESPN, all kinds of stuff. And what I always found was that when I was one person in an organization of 10,000, I was never maximizing my potential.
Mm,
That's what was really eating away at me. And I also hated the corporate politics. I was not going to kiss someone's ass like in the way that you really needed to make the right friends. And it wasn't the best strategic move, but I just didn't
mhm.
have it in me to do that.
Yeah.
And so I would do potentially more work and better work than the next person. That next person would get a promotion. I wouldn't. I'm a very principled person, and the principle of fairness was just killing me. So I sat in the corporate world for like 10 plus years feeling like I wasn't maximizing potential and I wasn't doing the right thing for myself to really feel like I was enjoying every day. So that was a struggle that you'd mentioned. And it was only until I went down this path that I really felt like I was actually maximizing two things. One is I really like what I'm doing. And two is that I was actually maximizing my cash flow and net worth for my family, which is fantastic, right? For myself and my family. So it really kind of killed two birds with one, or one bird with two stones, or whatever the expression is. I'm getting it wrong. Anyway, so that's like the personal side of things. And so it was a very long time ago at this point because I got out of the corporate world in 2007. So it's like
Mhm.
16 years. But that's what I kind of experienced. And it was really frustrating because I was just like trying to build the best resume possible, literally just making the best resume possible with the right MBA, the right jobs, kind of like dealing with whatever I had to get up the ladder slowly. And probably over time I would have gotten up the ladder slowly just because I was always a long-term thinker. So that,
Mm,
that was a helpful approach. On the investing side, what happened with me is that I always used to be interested in investing. I used to watch CNBC even when I was at work, and I couldn't tell you why. And when the dot com crash happened, I was sick and tired of the stock market for two reasons. One was the volatility. So I'm a really low risk, kind of slow and steady, long term thinking guy. And to watch the market go up and down 30% in a year was just the wrong fit for me. That was number one. And number two was a lack of predictability of where the stock market was going to be in 10, 20, 30 years from now at that point for my long term retirement account. And so I started to look at different ways to invest, came across the concept of cash flow and kind of cash flow within real estate. And I ended up realizing that what I really needed was predictability. That's what it was the
mm,
best fit for me. And by the way, there's plenty of people listening to this. They're not looking for predictability. They're looking for appreciation. They want to be in a ground up development, whatever it is. There's 1,000 ways to invest, and none of them are wrong, right? This is just the best path for me. And so I started to dabble in real estate syndication starting in 2002 in more stabilized, more diversified tenant based, experienced sponsor scenarios. And I ended up rotating all my money from stocks and bonds into cash flow of various forms, not just real estate syndications between '02 and '07. And my goal at the time was not to get out of the corporate world. I know a lot of people I speak to are like, okay, I want to invest X amount per year. And after Y number of years, I'm going to get out of the corporate world. That was not my goal. My goal was to just get my retirement piece on the right, more predictable path that I wanted that was a better fit for me. So, ironically, what happened is that you fast forward to 2007, and I had been promoted within Toyota, switched divisions, but on the same location campus. And I had a new manager, and I was having major challenges with the new manager, and I was just getting fed up. And it was a really bad scenario, honestly. And I decided to take a risk and leave the corporate world at that point because I had enough cash flow built up to live off of, even though that was not the intention of the cash flow. That's how I ended up down this path. And at the time, it seemed like the worst thing ever that was happening to me because I was so strict with my resume that for me to pick up and actually quit a job was like never happened before. I never pictured it happening, right? But it ended up being the best thing that happened to me, honestly, having that challenge because it put me down the right path for myself, which is what I'm still on today. So sorry for the long history.
Oh, no, you're good. I think that these types of experiences are what most of us can relate to. I always talk about how I was just raised in like this regular old middle class household with two parents. My dad graduated from college, my mom stayed home. It was just this very kind of vanilla middle class lifestyle. And I don't feel like that is a very inspiring story for most people. But then people will say, no, that's exactly how I grew up. And so I think it's more relatable when you can just share your background because I think what most people who are going to be listening to this are really feeling is I just did everything that I was always supposed to do, average middle class. And I have this thing I need to break out of that. And I don't know how because good is the enemy of great, right? We just are afraid to leave something comfortable for something that might be amazing. And I know my husband has struggled with that for years because he'd be like, oh, I need to change jobs every 2 to 3 years so that I can get a pay raise. But he never would because the devil was always better than the devil you don't know. And he really regrets
Yeah.
that now. And looking back, and I think that our message is just to tell people like, hey, it's not rocket science. So I had thought about two things while you were telling the story. And the first thing I'm curious is this may be our listeners' first exposure to real estate syndications because we're the passive income adventures, but we're really powered by commercial real estate. And so sometimes people are like, "Hey, I want more passive income," but they don't really know if that's a real thing. Is it a scam? Is it a myth? And they come in here and they're like, "Oh, wait, commercial real estate syndications? They don't know what it is." So how did you find out that that was a thing? Because it's not
Yeah.
exactly a normal type of concept for investors.
Yeah. So not only was it not normal back then, but without the internet and without social media, it was like much less known. And there was
Mhm.
no nothing could be publicly marketed. It was much harder. So I had the fortune of, so just taking a step back, it happened to be that my grandfather and my father were both involved in real estate. I never
Mhm.
got involved with them, never learned from either of them, unfortunately. But
Mm.
my grandfather was full time. My father had been a commercial real estate broker at one point.
Okay.
And so I had a little bit of exposure, but like really not more than what I just told you. Okay. Literally just knowing what they were doing. But what happened is that a longtime friend of my family, I was talking to him and I grew up with him since I was very young. He lived a few blocks away. And his father had been syndicating opportunities already for 10 to 20 years. And so they were very experienced in the commercial real estate space. And I decided to start investing with them. And ironically, I was in the US, but I'm from Montreal and that's where I grew up. So I was investing in a different currency into Canada because I figured I could both trust them and also learn from them, probably much more than just a random person. And so that's how I started, and that's how I even heard about it. And actually, what I did to accelerate my knowledge was back then, you really had to go to individual in person meetings. And luckily, I was in Los Angeles, big city. So you can go on to like a meetup.com that was just starting back then.
Mhm.
And that's where a lot of the meetings were posted. There weren't that many, but they were on there. And so I probably, at that point, I didn't have any kids or anything. So I actually averaged going to probably like 2 to 3 meetings a week for quite a long time to learn. And that's when I started to learn more and more about how this worked, various asset classes, et cetera. So that's how it all started.
Hmm. Okay, so I know that when I first started hearing about this was probably 2018, and the law for advertising changed where you can advertise to accredited investors, changed in what, like 2013. And so you jumped on board before that across country lines. So did the Canadian rules, were they a little bit different at that time where you could had more access to it, or was it just luck?
Well, I was investing through a direct relationship, so that wasn't an issue. I
Mhm.
don't know the Canadian public advertising rules. I don't even know them today at this
Today, yeah.
point. I invested for about probably like 7 or 8 years into deals in Canada, then I stopped because the currency became very challenging. The currency
Mhm.
exchange, like the gain or loss of that was like not predictable. And so
Okay.
then I realized that wasn't a good predictability fit for me. But anyway, so I don't know the specific rules out there. They're probably similar and different in that they're probably modeling some stuff after the SEC, but doing their own thing. That's my guess. But I think that it wasn't until I think it was actually the rules were passed in 2013 here, but I don't think they went into effect until 2015
Mm.
for Rec 506C. I could be
Mhm.
wrong. But it was around that area where really the public marketing became a thing. And then also the crowdfunding sites, those rules were finalized on the same timing, but they weren't allowed to launch until 2015.
Okay.
Same idea. So those all started as well, like the Realty Moguls of the world, et cetera. And so then people became much more aware of this type of investing just in the last, 5, 7, 8 years.
Yeah, and I feel like my husband, when he got laid off in 2017 and we made this whirlwind move across the country, it was almost just like the prime time to be getting into commercial real estate because people were learning that this was a thing. They started offering deals. We were not accredited at that point, but we found out like the accredited investor is a thing. Let's make a goal to hit that as fast as we can. I almost feel like in some ways it was just like all the forces coming together to lead us into it. But I'm always fascinated when people found out before that where it came from.
Oh
And
yeah.
it really is just who you know. Sometimes I get a little upset because it's almost like the rich get richer. People hang out with people who are like them. And sometimes it's really hard to find wealthy people who are making these offerings because we weren't even allowed to talk about it. And I think that in order to protect investors, what it ended up doing was hiding certain things and making it was a rich get richer. But I don't think that was a consequence that they were going after, but I think it was an unintended side effect of these rules.
I agree. It definitely made it difficult. I think it was an unintended consequence essentially. But I'll tell you that like in '02 to '07, when we had the run up in the last cycle,
Hmm.
I mean, there were meetings in Los Angeles you can go to, monthly meetings that were attracting upwards of 400 people every month to come at that point. Now, those are the biggest ones, and there were smaller meetings as well. So there was like a little niche of a whole situation going on, pre social media, pre.
And did you find those you said on meetup.com back in the
Yeah,
time?
meetup.com is where I don't know when Meetup launched, but I'm pretty sure I found those meetings on there. So it must have been back in '02 or something. The internet was really starting to gain traction with the dot-com era back in the late '90s. And so I'm guessing they probably had launched already. And there was already a ton of stuff posted up on there.
Okay. I think I found my way into this by meetup.com as well because I was looking up business networking meetings and I showed up at one where they were selling some real estate education. And so I went home and did some research. And it turned out that by researching that, I found Bigger Pockets and I found my local RIA organization, so my real estate investor club.
Mm.
But I don't think I would have ever thought to look that up if it hadn't been for this meetup where I was just looking to network because we'd moved and I was, should I restart my business? What should I do? So I think I don't use meetup.com a whole lot anymore, but I just feel like you got to give a shout out to it because bringing people together and the network is really what makes this industry go around. So it sounds like both of us were a benefit of just trying to meet new people, not the same people that we were always hanging around with, doing the same old thing.
Yeah, and I will say this though, Meetup is still a fantastic tool. If you go onto meetup.com and let's say you're brand new listening to this and you just want to go to a bunch of virtual meetings, which of course didn't even exist a few years ago,
That's true.
there are meetings I mean, you could literally do a meeting an hour every day of the week, all 7 days a week, and not cover nearly all the meet, of course, because they're all over the US. So it's a fantastic resource if you want to be able to just go to stuff very easily in your pajamas watching meetings. It's fantastic.
Let's kind of branch off from that where people can get trapped into that every hour a different meeting and never actually take any action. And you said a couple of things that hit me that I identified with because mentioned several times your long-term outlook and your investor horizon and even maybe alluded to the fact that it might be a little bit boring. But at the same time, I feel like for years I was trying to be an entrepreneur and I never wanted to run a business. I never wanted to hire people. I would always get frustrated because I was spending my money on equipment or marketing or whatever and I wasn't able to have any left over to invest. And I realized now as an investor like my mindset isn't actually that of an entrepreneur. I don't think, oh, if I want more money I'll just go make more money. It was always like, why can't I invest my money and let my money pay me, let my money work? And so it sounds like you have that kind of same investor outlook. When did you discover that about yourself? Like maybe you're not an employee, maybe you're not a business owner, entrepreneur, maybe you're just a long term thinker and maybe better suited to being an investor.
Yeah, well, so it's funny because God, when I left the corporate world in 2007, the first thing that came to mind is I don't want to start a business.
Yeah.
I don't want to deal with people. I don't want to deal with politics. I don't want to deal with bureaucracy. Like I just literally, and that's actually held true to today, right? A lot of people over time ask me like, why don't you launch your own fund? Why don't you syndicate a deal? With your knowledge, you'd be making a lot more money, and they're 100% true. And but I tell everybody the same thing. And it's I'm from Canada, so I'm going to say it this way, but it's a very un American way to think because Americans tend to think like, how do I maximize and make the most of everything? Right. And that's not necessarily a bad thing. But for me, and it's funny because similar to what you said about your husband before, I always have said to myself, I'm not going to start a fund or a deal or whatever it is because I don't know if I'm going to like what I'm doing. I know I like what I'm doing right now.
Yep.
Right. And so I don't want to mess with that. So I'm not going to make as much money long term, but I'm also know that I'm going to actually like what I'm doing with a pretty high degree of certainty, right? So that's why I've gone down the road the way I have. But it's really as a result of having spent all the time in the corporate world that I was able to say to myself, I do not want to start a company and I don't want to build a company. It's just not the right fit for me. So I got lucky. I mean, the fact of the matter is I got lucky because I happen to like investing. I happen to like looking at deals. I love networking and talking to other people. I like helping people. So I just got really lucky. But it took me a long time, you know, just like anything else in life. I struggled for many years until I ended up down this path. And it
Mm.
was just a force of luck that it happened.
I felt like I stumbled into it in a way, but it felt like I was coming home at the same time. And so I think the last time that we spoke, I was talking about wanting to increase our cash flow so that my husband could quit his job. And probably a week later, he got laid off. And so he decided, and
Wow.
I remember talking about we have a lot of equity trapped in projects that's not cash flowing. Our return on equity in our projects is pretty low, actually. Like I think it
Yeah.
was like less than 1% for a lot of the projects. And you told
Wow.
me like, hey, it's not really a time to sell right now. And so your equity is going to maybe be trapped for a little while and start releasing it little by little and investing in things that have more cash flow, because for a couple of years I was just investing for yield. I just wanted to get as big a pile as possible so that when we went to go invest passively, we had enough cash invested to spin off the cash flow that we needed. But when it was time to like, okay, we've got enough equity now, how do we convert that to cash flow? And little by little, we've just had to sell a property here or there, even though it's not a great time to sell. We did launch a fund because honestly, like I was getting a little bored. I was like spending too much time researching and not doing anything. And so I want to do a business, but maybe just part time. And so, how do you counsel people who are looking to retire? How long was it before you invested in your very first private syndication versus, hey, I have enough cash flow now that I can leave my job and it's okay, versus somebody who's needing to retire and needs that cash flow and able to be able to retire? Let's talk about cash flow.
Okay, sounds good. I should have said at the beginning, I'm not a financial advisor, investment
Yes.
advisor, accountant attorney, or anything. So this is not advice, financial advice. It's just my opinion here as an investor. So first thing I'll say is that it took from '02 to '07 until I had the cash flow built up to leave the corporate world. But again, it wasn't purposeful. It wasn't based on a
Hmm.
plan to do so. Second is that that didn't happen as a type of formula that everyone's probably assuming. I didn't have $1 million invested at 10% and that generated $100,000. That's not what happened. I actually ended up investing in non-syndicated stuff as well. That I mean, I'll try and make this quick, but a friend of mine had a web hosting company before Amazon, cloud
Yeah.
and all those like, AWS. And so he built out like a server farm and he was basically providing secure hosted clouds, private clouds himself through these server farms, but he was buying these servers and he had to lease them all. And he would lease it through a third party like Dell wouldn't give him a lease because he was too new. And so I ended up stepping in and he literally sent me the contract and said, if you want to match these lease terms, just do it as an investment. And that's what I did. And so just to give you some numbers, there was a 28% interest rate. It was a 3-year term and there was a 5% buyout at the end. And so what that equates to is a 50% cash on cash return for 3 years. Okay. And so the danger of living off that money is
Yeah.
that if there's nothing, there's a 5% buyout at the end. There's very little money at the end. But
Hmm.
the benefit of actually reinvesting that money and compounding it is that you're getting 50% of your capital back every year. And if you're compounding it and you put it on a spreadsheet and you start buying more, it's very effective. So I did this for 8 years, I think from 2004 to 2012. It was very lucrative. And so I had a combination of what I call like that's called fully amortized, where you're getting your principal and interest back kind of together
Hmm.
because there's not much residual payment. And then non amortized, typical real estate syndication, you're expecting a big payment at the end. Hopefully that will appreciate in value. And it's that fully amortized stuff that supercharged my cash flow and got me a much bigger balance, but it's very dangerous to live off of. So when I left the corp world in '07, I purposely started to diversify out of that. I was already diversified out of it, but to kind of taper off of it
Hmm.
is a better word because you can't live off of that sustainably. There's too much risk and you may eat through your capital. So that's what happened there. So it took a shorter amount of time because of a combination of amortized and non-amortized.
Okay.
Sorry, what was your other question? I've lost it now.
Oh, just basically how retired people who are wanting to retire now, who maybe are in
Oh,
my boat, a lot of equity, not a lot of cash
yes,
flow. So you were coming
yes.
at it from the other direction.
Right, right. But I also want to say something else though, because when I hear the word retired, I get concerned. No, I don't mean that in the way you're probably thinking. I get concerned because this type of investing is very illiquid. And
Yeah.
so I actually have calls with people who are 65 or 7 years old and they want to generate cash flow
Hmm.
and they are retired or even 60. And the first thing I say to them is, look, just make sure you're not allocating too much money to this because if you ever need emergency money, if you need to cash out, you cannot press a button on your computer and sell your Apple shares. This is not what this is. right? You're locked in. You may not find a buyer to buy your shares. It may be a hard time to sell it. This is not necessarily the perfect fit for someone who cannot have an illiquid position. And this is very illiquid.
Mhm.
So when I hear the word retirement, I think it's just important people to think about that. It could be a way to supplement your cash flow by taking a small amount of your portfolio and doing this. But I have seen scenarios, for example, I had an investor I knew who invested in a deal through his self-directed retirement account, and then he started to have forced withdrawals,
Yeah.
right, which happens after a certain age. But the problem was that the forced withdrawals were taking place when he'd invested in a syndication that wasn't performing, and
Mm.
so he didn't know what to do because he was having to pay the tax on money that wasn't coming in, right? And that was a very bad scenario for someone who's retired, who's already trying to, build up some cash flow. So there's a lot of things to consider when you're truly retired, if you're older, especially with this stuff. And my long-term goal, I'm probably going to talk about that later, but my main long-term goal is to eventually get diversified back into liquidity because I
Mm.
have been 100% out of stock since 2007 and into illiquid positions the whole time since then.
Mhm.
And eventually I have to be very careful with that. So I'm going to start probably one more cycle and I'll start diversifying back in. And then, frankly, my goal, let's say if I turn 80, I should have very little of money in this, in my opinion, because I won't have the liquidity. That's just my own comfort level.
Mm. So it's kind of like I read The Millionaire Fastlane a couple years ago, and he was talking about exiting a business and making a lot of money and then investing that. And he was a limo driver, and there was a guy in the back seat who was bragging a little bit that he made so much money off of a business exit. He goes, I invest in the most boring things like municipal bonds at
Yeah.
5%, 8%. It doesn't
Yeah.
matter. I have so much money that I can play at super low risk and still have plenty to throw around. And he said that was a turning point for him to realize that you can invest in a lot of boring stuff if you have enough cash. And so boring, illiquid, maybe the returns are a little bit lower, but at the same time, there's that liquidity that you need for cash flow that doesn't exist in a lot of the stuff that we're doing. But at the same time, the illiquid investments are less volatile. And so are you balancing those two things? Like, do you care much about volatility because you have to take it out whether it's up or down? How do you handle that?
Well, so I would say a couple things. Number one is that if you go with treasuries, they're not really volatile, right? So, and
Mm.
they're liquid. You can
Mhm.
resell them. Are they worth what you pay for them? It depends on interest rates at the time. But there are certain ways to do things where the liquidity is still pretty low volatility.
Mhm.
But on the other hand, what I would say is that if you go into a dividend ETF in stocks, and I'm by no means a stock expert, but if you
Yeah, me
invest in a
neither.
dividend ETF and you're getting, let's say, an average of, I'm making this up, 3% dividend from that, but it's pretty consistent in that, it's based off your initial investment as a 3%, right? And then those companies are, because they're such a huge basket, or maybe actually having some predictability because there's so much diversification. That's something I'm going to be looking into very carefully because you won't have the same level of cash flow. You'll have the liquidity, but you're also potentially maybe going to have a decent degree of predictability and less volatility in terms of the
Mhm.
actual percentage you're going to get. There will be some variation. So that's kind of what my thought is for the long term for myself as an example.
Yeah, and I have a lot of guests on the show who spend a lot of time in the stock market, and it's really interesting to have them compare their stock investments with their more illiquid real estate investments and the pros and cons of each with tax implications, with liquidity. There are all sorts of things to consider, and I think that that's a world that I see the most successful investors tend to combine. I'm not a
Mm,
maximalist in theory, but right now my portfolio looks like I'm a maximalist. So I think you, like you said, when you're thinking about retiring, whether you're retiring early or retiring at 65, it's really important to think about minimum distributions, your retirement, and all of these types of things that impact it because we end up talking about like how great real estate is. And sometimes we forget that there's no one stop shop. There's no one good solution for everything. So what does your within reason, like what you feel comfortable sharing, like what does your portfolio look like right now? And what does your investing strategy look like right now?
yeah. So my portfolio is hyper diversified on the illiquid side, on this type of alternative investing side. So I'm in over 60 LLCs actively right now,
Mhm.
which for the time
A
which we're
lot.
recording this is a pain because I'm chasing down still like probably 6 to 8K ones that are very, very late.
Yeah.
And I've been in over 150 to 200 different opportunities over the past 20 plus years. So because I do this full time, I end up in a lot of things. and I love the diversification. So my strategy has always been to put small pieces across a lot of things. That's just the approach I've taken. I actually don't necessarily recommend it. I think it's too much diversification, but it's just what I'm comfortable with. And
Mhm.
it's not normal for sure. I have, as I mentioned before, no stock, so it's 100% in this illiquid type of world, and I'm hoping to continue to go down that path for one more cycle probably. And that's when I'm going to really reconsider. Okay, what do I need to do at that point from an age perspective, but also I have some theories about where the economy is headed longer term, and I'm just trying to keep an eye on that. So
Yeah, the crystal ball, the crystal ball. I feel unequipped and sometimes incompetent to be able to predict what's going on in the economy and knowing any more about. And so the thought of diversifying out of what I'm an expert at, I guess it really just leads me back to passive investment. It's like putting my money with people who get that a lot better than I get it. So, how have you been able to cope with something that bothers a lot of people, that they don't have control, that they're passive investors? They talk about the passive income lifestyle and going on the passive income adventures, but then at the same time, they say, I don't think I could give up control of the investment.
yeah, great questions. I have spoken to a lot of people who, let's say, have either had an exit event in a business and are trying to determine if they should go down this path, or have been active real estate investors. Spoke to somebody today, actually, just before this, who has been an active real estate investor for 20 years, is now is
Mhm.
considering going passive. And the first thing I say to them is like, just make sure that you are comfortable being passive because you've been involved actively in something for so long, right? And it's a personality fit. And so in my opinion, if someone is having challenges going passive or even the thought of going passive, I'm not sure that that's the best fit for them.
Mm,
Because the challenge with being passive is that it's illiquid. So so I tell people, once you go down the passive path, you're putting yourself in a position where I trade control for diversification by
mm,
being passive. That's what I tell people.
okay.
And I want to get diversified across asset classes, geographies, and operators, right? And so imagine if I'm starting to go down this path and I need that diversification to help reduce the risk of actually making a bet on somebody else, which increases your risk. Someone else has control. That increases your risk to an extent. And let's say I go into two, three, four deals, and then I'm like, this is the wrong fit for me. Well, now I got a problem because I went down the path a quarter of the way. And as a result, now I'm in not enough things to be properly diversified. I can't liquidate my positions because it's hard to sell what you're in, and you maybe the wrong timing. And now I've got exposure to the passive side that's actually increased my risk to an extent versus the best way to do it or the optimal way to do it. So I always tell people to think really hard about this whole passive versus active before they go down the passive path. And I don't really think the passive path should be taken as an experiment. It should be taken almost like as an experiment because you're highly convinced it's the right path, not just a general experiment,
Mm.
for those reasons.
So some experimentation with what is the best fit, but not the whole idea of can I handle this? But at a certain point, most people say I can't work forever. I make more money in my active area of specialty for sure than I do by taking that same amount of money, investing it into a business that I'm going to actively manage. I will make more money doing that than I will putting it in a passive investment. But I can diversify. And then at a certain point, it's like, I don't want to work anymore. Now, I may not want to sit on a beach in Mexico, that's boring, right? But I want to have more control over my time, and it's not necessarily running a business or having a job. And so just being able to say, how does that work? Because even if you're active and even if you're not comfortable with giving up control, at a certain age, we really need to look more seriously at that. So how does that transition look like for most people?
Yeah, well, so what I would say is that one of the compromises towards being what I call active, but yet still having what would appear to be more passive situation is someone who buys, let's say, a portfolio of single family homes, right? Where there's third party property manager, they're on title, they can choose to mortgage it, refinance it, sell it. They may get a call in the middle of the night because of a tenant problem. They may have to screen tenants. They may need to approve the purchase of a new toilet, whatever it is. That's still active to me, right? That's that whole
Yeah.
control thing. And so, but at the same time, it's certainly less work than a lot of other active things you can do, right? And it generates cash flow. So to me, that's a very common path someone takes when they say, look, passive isn't the perfect fit for me, but I want the cash flow. And some people view that as more, I define it, everything I'm telling everybody here today on this is just my definitions. There's no real
Yeah.
definition. And so I define that as active because you have control, but some people who are active would probably define it as passive because it's mostly passive, but not all passive.
Yeah.
So that may not be a bad way to look at things if you're in that position.
Yeah, if you break it up into active income and passive income, in the middle of that is what I call residual income, where you do have to work at it, but it's more like a merry-go-round where you're spinning it around and every once in a while you can stop. do something else and then check on the merry-go-round. And so totally passive, it's a lot of work up front, but after you invest the money, you have to monitor it. But even if you monitor it, you don't really have a lot of say or control. If the deal's not performing, you're just watching it not perform when you're monitoring
That's
it.
true. That's true. Yeah, that's 100% true. All your work is up front for
Mhm.
sure. And yeah, I mean, yeah, you described everything exactly right.
Yeah. Is there anything that you can do when you see a deal that's not performing? Because I remember hearing a story that you told about how it's always more than one thing. It's like a little death by get the three cuts instead of one thing. It's always multiple things. So when you see a deal that's not performing, can you do anything? And two, is that why you're so diversified? Because you really can't do much at that point.
Yeah, well, I'm diversified just for peace of mind. I just
Mhm.
because if you look at what happened with Madoff and that whole Ponzi scheme,
Yeah.
obviously it's horrible. But at the same time, I would say that if somebody invested just 10 or 20% of their net worth in that one thing, it would be very challenging, but not a complete disaster, right? And so the diversification can really help a lot. And so that's one thing, and that's one of the reasons why I really love the peace of mind of diversification. The other thing too is that I've been in some scenarios that, I've actually been proactive in trying to help the situation. And so, for example, I was in a two single family flip funds in 2011 and 12.
Mhm.
And within a year or two, there were three partners. Two of them were on the ground, the actual operators. One of them was a back office guy, admin. And they had a partner dispute. The two guys who were the on the ground guys with all experience left. And now
Mm.
we have this guy who doesn't really know what he's doing, trying to manage these properties. It was not working. So I actually stepped in. I kind of negotiated that he release the properties in exchange for investors releasing his liability. And then I found a new manager to replace him. We got the vote. This is a ton of work, by the way,
Yeah.
right? But this is what happened. And we ended up getting someone to salvage up, managing it correctly, and selling it off correctly, right? And so it didn't become a complete disaster. There are ways to do this. And so this is actually one of the reasons why it's so important for investors, passive investors, to read the operating agreement and understand what they're getting into and be sure they're okay with the terms, because some of them will not allow you to ever vote out a manager. Some of them will allow you to vote out a manager with a 50% majority vote. Some of them will require an 80% majority vote. Some of them require an 80% majority vote, which includes the co-invest of the manager, which, if the manager co-invested 10%, is a very high bar, right? So you have to look at the terms very carefully, because when this 1% instance occurs, I call it like a 1% risk. When that occurs, you have to have at least the rules lined up that you can actually work with it. But there are things you can do. It just takes a ton of work. The other thing I will say is that the average investor, let's say they invest $50,000 into a deal and something goes wrong with it, that's unfortunately not enough money where if you start getting attorneys involved, it starts to add up, right? Like it's almost like too expensive to get the attorneys involved. So you're going to take the write off probably instead. So you
Mhm.
have to have either a group of investors get together and make it worth their time collectively, or there are instances where nothing will happen, because it does take the initiative of someone to take on the work. So it's very tricky for sure.
Mhm. I feel like while you discourage hyper diversification, because it's very time consuming, meeting new operators, staying
Yes.
fresh. I think if you're going to only invest every 3 years when your project comes back, you're kind of rusty. You don't know who's out there doing what. You may have forgotten how
Yeah.
to read the spreadsheets. And so staying active and doing that, I think is a really important part of even being a passive investor, is just because it's all about the network and your network can get rusty. Is that part of the reason why you invest the way you do, is just so you don't forget how in between?
Well, I just have the fortune of doing this full time. So I'm not going to get rusty because I'm just doing this all day, every day. But for the average person, I would say this: the most common diversification target that I hear people having of a big diversification around is 20 different opportunities. So spreading, your money equally across 20 things.
Yeah.
If you're going to do that, it's going to take probably, if you're very careful in what you're getting into, it's going to take several years to deploy your capital properly. And by the time that's all done, some of it might start to come back, et cetera. So you're constantly in the game if you're really properly diversified, or at least heavily diversified.
Mhm.
So that, I think, is a bit of a less of an issue for someone. At the same time, I think you make a very important point. Not only can you get rusty, but almost even more importantly is you really need to stay on top of what's going on, both the real estate cycle and the economic cycle, so you can make the best decisions for yourself with that knowledge about if and when you should invest in what, where, right?
Mhm.
One of the most common things I see happen is I will get a random person contact me who's brand new and says, I just exited this company, or I just scrounged up my first $100,000. It's taken 3 years. I need to invest it now. And the first thing I say to them, is this the right time to invest it? Like, do you even have an opinion about whether this is the right time in the cycle to invest it? And in what, right? And a lot of the people are just so focused on getting the money deployed, they're not taking the time to stay on top of the economy and the real estate cycle because timing is critical. So that's another thing that's really critical. I think people need to seriously consider. And if you're becoming rusty, you're probably not staying on top of the economic news either. And by the time you go to redeploy the money, you're not going to have a well-educated opinion whether that makes sense. So
Yeah.
you kind of need to stay on top of this on a regular basis to really optimize it.
Yeah, so it's not as passive on the upfront as sometimes people think it is because you have to vet all these opportunities. And so I think there are people out there like I'm not really that interested in the stock market. My brother is a full-time stock investor. My siblings are all heavily in the stock market and I'm not even on their thread where they talk about this stuff. I'm the only sibling of 8 that's not even on the text thread because I'm just so uninterested in it. I don't want to follow it, don't want to follow business news. So what advice can you give people who are like, I just don't want to be as this on top of it, but I know I need to invest because I have a life cycle of working actively.
God, and you're talking about not in the stock market. It's easy to do that in the stock market. You can go into like an S&P 500 ETF and a
Mhm.
Nasdaq ETF, and you can decide to be done with it if you want to make it that simple,
That's kinda
right?
what I do. The stock
Yeah,
I do have, that's where it is.
and if you listen to Warren Buffett and all these other very smart people, you'll find out that you're actually best off doing that anyway, right?
Okay. That's not what
Just
I
like
believe.
well, no, that's not what I mean. What I mean is if you're going to go into the stock market, the way to approach the stock market is to do that. If
Mhm.
you're working and you're not focused on it full time, that's the
Yeah.
best method to take with the lowest cost and the highest return long
Okay.
term on average. But, if someone is too busy and they're just going to get into something once in a while, it's, I mean, one of the better things for them to do is because of the amount of networking it takes to find deals, et cetera, they can take a look at crowdfunding sites that will provide a lot of deal flow proactively to them, or they could take a look at joining investor groups that will do the exact same thing,
Yep.
right? That way, they're not the ones trying to find the deals directly. These are intermediaries I'm referring to. That means you're going to get lower return on average for the same amount of risk because an intermediary is doing that work for you in terms of sourcing the deals.
Correct.
But that is an option. There's pros and cons to it. But when someone's really busy in the corporate world, it might be the right fit for them.
I think that diversifying into some funds, like what you're talking about, because I don't believe that I can beat the S&P, and that's probably why I'm really not that motivated to follow it that closely.
Mm.
But I believe I can have more effect on my real estate investments by choosing better deals, better operators, also by diversifying across a couple of different funds where it's passive. They make those decisions for me, and I'm going to pay a management fee for that. For me, as I get and I'm just looking for people that I really believe can do a great job. And so for me, that's what's been working. Like, don't try to beat the index and pay attention on the real estate side is where I find my time is best spent. So let's jump into the future, not just the future of the economy, but the future of Jeremy. You said you had a couple of predictions, and we'll say the caveat that you're not a wizard. You don't have a crystal ball. So where is the economy going? Where is your investment going? And you personally, what are you seeing in your future?
Yeah, I'm going to take the long term approach here and not the short. Everyone's focused on a short term at the moment, and it makes sense. There's a lot going on. We may have a recession. I personally believe we're going to have one. Being
Mhm.
very careful with that. But I have a bigger concern, which is all the debt and all the debt that the government's accumulating. And I'm not here to tell you that the whole country is going to collapse in 2 years. It's probably not going to happen. That's
Yeah.
not realistic. But if you take a look at what happened with Japan and the amount of debt that they built up and what eventually happened to them, I'm very concerned that this coming cycle that we're going to go into next may be the last cycle we have for good predictability in this
Mm.
type of investing. It's a theory I have. And so if you take a look at what happened in the 2000 decade, based on the level of debt that was already accumulated by the government, which is much smaller than we are today, the long run potential of the economy was about 4% GDP growth per year. That's what was the realistic target that the government could have. Then you had money printing in 2008 and 9 after that recession. And what happened is that in the decade of 2010s, that went down to 3% because of the debt drag and the interest payments and everything else that was happening on the government and economy. And so when you had, Trump at the time, who was president, in the media trying to get to this 4% target, it was literally probably impossible or very close to impossible because there was too much of a debt drag already. And that's why you couldn't get past 3%, right? So now we have an enormous amount of money printing that took place because of the pandemic and possibly more coming up with a potential recession. And my belief is that we probably will be in a potential GDP growth range of 0.5 to 2%. I'm approximating, guessing, in the next cycle. And what's so critical for us as investors is that we depend on a predictable, consistent growth in the economy, be able to keep up with inflation and raise rents over time that people can afford, right? And so that GDP growth should allow for that. But what happens after the end of that cycle? We're going to print more money, probably. And then what happens? We end up like Japan. Japan ends up in a situation where it's plus or minus 1% GDP growth, depending on the quarter, because there is so much debt overhang that there's a lack of predictability of what's going to happen in the economy in the next quarter, in the next year, in the next 5 years. So when I invest for predictability, I'm concerned this is my last true cycle of being able to actually get predictability and peace of mind of like actual predictable economic growth on a sustainable basis throughout years. And so I'm going to be reevaluating at the end of the next cycle as to whether this is going to be the right type of investing for me or not based off of that. We're going to have to see what happens. If we see GDP growth between 0.5 and 2% annualized for the next few years, then I'm possibly onto something. And that if they print a lot of money after that, that could be make things very challenging going forward.
So, what do you make of the old adage that you always say that it's never different except this time? So, the predictability, I think, is a really good point because we have so much more data available to us now. And it looks like things that used to be, oh, if we're going to follow the pattern, right, this is what it's going to look like. But then it never quite follows the pattern. And so everybody's like, oh, no, it's just like it always is, except for this time. And I'm like, no, it really never does quite repeat. It just rhymes. So, to say that we're going to have a loss of predictability, I think is accurate. But at the same time, we hear people say this a lot, and then the pattern just kind of tends to repeat itself.
So, so what you're saying is that I don't 100% understand your question. I guess, are you asking, oh, is it really realistic for the economy to go plus or minus 1% GDP and the predictability to be gone because it's been so predictable for like decades and decades? Is that what you're saying?
Yeah, I feel like people have a tendency to say things are not predictable
Different.
right now,
Got it.
um,
Got
but
it.
but then they're like, oh, it always happens again, and so
Yeah.
that yeah, it's
So
always
you're
different this time.
Yeah, so the only reason why I have any degree of confidence is the wrong word, but any thought that it could end up like that is just because that's exactly the path Japan went down, and it was all a question of how much debt to GDP they had, and once they got to a certain level, that's the wall that they hit. So
Mhm,
I'm actually using, ironically, it will actually be using history to rhyme by actually taking what happened with Japan and applying it to where we landed with the US today. You
mhm.
see what I'm saying?
Yeah.
So it actually will match up to history. It's not different than history. It's just different than our past history, but similar to history of another country that ended up in the same place.
Mhm.
So that's why I think the probability is decent that we could end up down that path. Hard to tell, but that's my concern. So I am very much watching that on the long term. Now, as far as my own personal investing goes, aside from that concern, I'm going to be favoring more and more liquidity over time for myself because right now I'm literally completely illiquid. And I've been doing that because I think I have been able, to your point, to be able to pick and choose things to get an outsized return with some benefits, tax benefits, and deferring and all this type of thing that I thought was worth it compared to just going into the S&P index,
Yeah.
right? Otherwise, none of this is worth it in terms of returns. But I will be starting to probably, if not, fully change my strategy because of what I just mentioned before. I'll definitely be rotating into diversifying into liquidity as I age further out from there for sure. And knowing my personality, I'm probably not going to wait till I'm 80 to be 100% liquid because it's probably going to be way before that,
Mhm.
just my personality.
Yeah, we're finding because we retired early, semi-retired. We're looking at our portfolio much differently today and over the last year preparing for that than we ever did when I first started this. And we've only been at it for 5 years, and I feel like we have a long way to go. But at the same time, when people would say it at the beginning of my journey, they're like, "Oh, it just depends on what your goals are and what your needs are." And I'm like, "I don't know enough about this to have any idea what my goals or my needs are." And I'm still zeroing in on that. So what do you see beginner investors doing that you wish that you could tell everyone, like, please just do this instead?
Well, really, the number one thing is what I mentioned before, which is it just, let's just put this into like historical context. From a timing perspective, we're currently recording this in August of 2023. Imagine it's August of 2008, and you call me up and you're a new investor, and you say to me, I just saved up $100,000. I need to deploy it. What should I do? And I say to you, take a step back. Is this the right time to deploy that money? And I'm not trying to imply that we're going to have a housing crash, whatever, just the timing, like cycle
Mhm.
timing perspective, right?
Mm.
So that is always the number one thing that I find that people have like spent all this time getting to this position. And now they're like, you know, they basically found the stadium. They got to the starting line of this race on the track. And I'm like, are you in the right race? Is this the right race? And even though you spent all this time getting there, right, at this timing, or should you be in that race in a year from now? Should you come back? And people are very eager, but they don't take a step back to really determine whether the timing is right. And to me, right now, that is absolutely critical because I think it's a very high probability of recession, which also means there's a high probability of asset prices continuing to decrease further, which would imply that for most opportunities, the right thing to do is wait just a little bit.
Wait for those prices to come down so there are more deals on the ground?
Also, wait to see how the recession plays out, how
Mhm.
severe it is or not, the impact it has on revenues, vacancies, et cetera, so that you have more predictability going forward, so that you're not taking more risks than you realized right
Mhm.
now.
Especially for somebody who's new into it, I think that advice can be sound, but I find a lot of people just don't ever end up taking action because they're $100,000 is really not that much in real estate, and it's not enough to really diversify, so they end up just letting fear rule them and never actually doing anything. So, how do you get people over the hump of research, 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 and fear to actually doing something?
Yeah. So I actually see two things happening. One is what you're referring to, the fear, but the other is almost like, the shiny object syndrome where people
Yeah.
just keep researching different things. I mean, I've literally, the extreme cases I've seen, I remember going to in person meetings and I'd see the same person 4 years later checking out a new asset class, but they never invested. And I don't know if it was a combination of fear and shiny object, but that can happen too. So what I do is my belief is if you're brand new, you want to focus on one asset class first. And the
Okay.
one that I tell people to focus on is the one they can understand most easily. So if you grew up in a mobile home park and you understand that asset class the best, do that one first. You will be way ahead because you will understand how it works and you will be able to learn it much more quickly. Most people tend to choose apartments because a lot of people have lived in apartments before. They're also one of the most abundant asset types available in any city,
Mhm.
right? Many more apartments than self storage facility in a random city, right? So easier to find deals. But they'll take apartments because they understand them. And the cool thing is about this type investing is that 80% of what you learn on one asset class can be transferred to every other asset class and then just some tweaks on the other 20%, right? So focus on one asset class first, learn it really well. Then you get to the point where you learned it well enough, you can get comfortable enough trying it, right? Try it a couple times, see how it goes, and eventually you'll know the timing is right to then go to a second asset class and the third asset class down the road. But one at a time. And I feel like if someone focuses on one, that will help them to eventually deploy and actually reduce their fear, but also completely eliminate the shiny object problem.
Well, and I think the advice would go equally well for people who would have a tendency to pull the trigger too fast and just say, "Oh, well, so and so's investing in it, so I'm gonna throw some money in it there." Focusing on one thing and the saying, "Okay, I'm gonna spend this much time really researching this one thing before I invest in anything." So I think that's a universal solution depending on if people are more fearful or more risk takers.
Yeah, and it's that fast challenge that also is what I see when people are like, okay, I'm now in a position where I can invest. I've got to deploy the money right now. Where do I put it? It's got to go. It's got to make some money for me,
Mhm.
right? It's the same challenge. But I do agree that focusing on one asset class can be a big help.
Yeah, definitely. It's like the one thing. It doesn't mean you have to stay on the one thing forever, but 6 to 12 months on one thing, I think is an appropriate amount of time for people who either move too fast or too slow. Just set some boundaries for yourself, set some goals, set a timeline. What do they call smart goals or measurable and they have a time limit? Set some of those
Mm.
and just make the decision you're going to take action not until this happens or when this starts to happen, take some action. So give yourself some boundaries. And I think that's really helped for me because I vacillate between those two, actually. Sometimes I'm like, oh, I'm tired of looking at this. I'm just going to throw some money at it. And other times I feel like I'm really just enjoying the research and I end up not really doing much with it. And for people like me, I have to remind myself that there are solutions that can help get me out of these situations. Okay. I can we just go like a 2 hour podcast today? I think we have to wrap
Whatever you
here.
want. I have time. It's whatever you think is going to be helpful for everybody.
Yeah, well, I wanna ask, like, some selfish questions here at the end. You are not a financial advisor, I am not a financial advisor, this show is for educational purposes only, but right now, as we're going into a recession, let's revisit the call that we had several months ago, which you probably don't even remember because you have a lot of calls with a lot of different people, so just being trapped in equity rich, cash flow poor, going into a downturn, and not working. So, do we need to go get jobs? Do we need to double down on raising capital in our fund? Do we need to sell stuff even though it's not a great time to sell? What do people in my situation do in times like this?
Oh boy. Well, there's a lot of directions you could take. A lot of it's subjective. One thing coming to mind is that if you have alternatives to invest in, and you want to unlock some of the liquidity and those are active, you can obviously get, either refinance or get a second loan or a HELOC or whatever it is to pull some of that out. Now, I am not a big fan of a lot of leverage. So,
Yeah.
but everyone is going to have a different position. And if you're really let's say you're in a 10% loan to value position and you're like, oh, I'm going to bump it up to 50 or
Mhm.
40 or 30. That's actually like pretty reasonable, right?
Yeah.
And you can unlock them. I think even depends on the rate, I suppose you're going to get, but it does. You obviously have to have positive leverage, meaning you need to find a higher return than what you're going to pay on those loans. But if you find the right opportunity, that might make sense to help increase. Instead of just sitting on it, I'll just say this. There's three buckets of things I'm actually investing in right now, even though it's very challenging. One is US Treasuries for my cash,
Okay.
which probably won't help in this conversation because you're probably not going to make more than your loan's probably going to be more than 5.5%, for
Mhm.
example, right? Number two is very unique opportunities with a lot of padding so that the concept is be defensive. And in the event that we have some price downturns, if you can get into a deal that has a lot of padding up front, meaning there's a pretty big price reduction or has some unique aspect, then it could be worth taking a dip right now. And
Mhm.
so, a really good example of what I've done this year for that is something called tax abated apartments, which we can get into. It's kind of complicated, but it creates a lot of padding by switching the structure between putting it under contract and when you close so that
Mm.
you have a lot of equity padding. And the third is very unique opportunities that you don't have to worry about the depreciation on, which we kind of touched on before, right? Those fully amortized things. Those much more important to focus on. Will this do well during a recession? Because your asset value isn't going to hold anyway. So I've been investing in ATM machines since January 2008, since before the last recession. And I saw how it did in the recession, and it tends to hold pretty well. And I have no hesitation going into it at this timing if I think it's going to hold well into a recession because I don't have to worry about the asset value going down. It's literally just a bill feeder and a case and a screen and a keyboard and a computer, and that's all depreciating. So there are some odd opportunities out there where you don't have to worry about the asset price depreciation at this timing. It just has to be in something you think is going to do well during a recession. That's still deployable.
Mhm.
So these things are not easy to find. They are unique, but they're out there. So those are some options. There, so meaning what I'm trying to say is that there's still stuff you can invest in today, just a much lower volume. Going back to your original question, you can kind of consider all that, but it's a really tough question to answer. It depends on your risk profile, what your job options are, how much money you really need to generate. There's a lot of questions there.
Yeah, I find that the more I get into people's situations, there's so much complexity, and this is why financial advisors who are good at what they do are so valuable because they can find blind spots and problems. Because I just keep feeling like I'm just doing the same runaround over and over again. I don't want to take out a HELOC because the rents don't support the higher payment. And so fortunately we have been stashing cash in our life insurance policies because for
Mhm.
liquidity, because we were signing on loans. Like when we got a new apartment building, we were the loan guarantors for net worth, liquidity, and experience. And so we had to keep a portion of our net worth liquid in order to sign on those loans. But we haven't really signed on a loan for a while. I was like, well, that's probably too much liquidity sloshing around for, we're not going to be signing on anything in the near future. And so we have started to skim off of that liquidity to make some investments in some stuff that's cash flowing, some debt investments. We don't get any tax advantages from that, but we have enough depreciation from our other projects. I feel like we can get a little bit more interest or active income from that. So that's one thing that we've been doing. And we have sold a home on seller financing, like a lease option. So they gave us a down payment and got us out from under a house, like the ticking time bomb house where you're like, when's that roof going out? So got out from under that, but they're still making a monthly payment. So we have made some moves, but I feel like we're being very, very cautious, which you would probably say is a good thing. But at the same time, I'm feeling very impatient because not quite sure what we're doing next. So we're just taking it very, very slowly.
Well, two things I'll say about what you just said. One is that the one good thing about what you're doing with the life insurance is that you're actually borrowing from yourself and you're going to make the interest back yourself. You're not paying interest to somebody else. So
Yeah.
that's a very good thing, right? Relatively speaking. The other thing is that there's a big argument to be made that based on affordability metrics that the home prices we have right now are pretty much at or near peak likely. And even if peak means we go sideways for a long time and then it gets eroded by inflation, either way, very good time to sell home, most likely, just based on historical data and affordability data. So that's another interesting thing.
Yeah, and I don't know if I ever really thought about it quite like that because people are like, "Oh, don't sell a house right now when things are down." But I guess the question is, do I anticipate those going back up? And not really, because I see interest rates going up and I see that those prices are probably going to flatline for a while. Our houses that we can sell, like most of our projects are with partners and syndications. And so it's a big to do to sell. But our single families and things that we own on our own are mostly in Salt Lake City, where I feel
Mm,
like the values are, it's a good market, but we've seen the value. It's already capped out. And so I kind of feel selling things in that market is probably not a bad plan, especially when I can sell or finance it for more than market value. Because I'm kind of padding in that extra year or two that they're
that's
going to take to
interesting.
cash me
Yeah,
out. So
interesting. Yeah.
yeah, it's a balancing act, and people ask me all the time, like, "How do you actually make your money?" And I think for people in a W-2, it's hard for them to understand. It's like, well, I don't really have a simple answer for that because millionaires have 7 streams of income. How much time do you have to hear about my 7 streams? And
Yeah.
so there's just a lot going on, a lot of moving parts, and I think that that's part of the complication that a lot of people shy away from, of hyper diversification or 7 streams of income or whatever. So how do you handle juggling everything?
Well, the truth of the matter is, and we talked about this a little earlier, is that a lot of my work is all up front. And so what I do is, specifically for the passive investments, every month or quarter that I'm getting distributions, most commonly quarter, when I invest in something, I have a spreadsheet. It's a very rudimentary Excel spreadsheet. And I will put in, so let's say the year one cash flow is 8% projected, divided by four. I'll put in the timing in which I'm supposed to get it, whatever the months are supposed to be. And I'll just put those amounts in. And when I get the checks, I'll compare what I got to what I was supposed to get, and if it's plus or minus more than 20%, call it,
Mm,
then I'll actually look into it. So even if it's too high, I'll look into
mm,
it because I want to understand what is going on, right? Like, why is that happening? And then if it's too low, I'll look into it, but with a degree of tolerance because no projection is ever perfect, right?
yeah.
And so the time juggling of the stuff I'm already in is not that bad,
Okay.
honestly. And also, it's to be fair, it's not that bad because I invest on the low risk side of the spectrum. And so that means I have the highest degree of predictability based
Mm,
off of going for the lowest risk side of the spectrum, right? And so therefore, it's not often that something is just way out of whack because I'm going in something that's 80 to 100% occupied, stabilized, may or may not have any value at upside. And so I'm starting from a point at which, in order to get really out of whack, like you said before, often more than one domino has to fall. And I have the benefit of having more than one domino up to begin with to
mm,
keep that in check.
okay. I probably ought to let you go. I know that there are people out there that could really gain a lot from booking a call with you, from attending a conference that you're going to. Where are you going to be over the next couple of months? Because I know that you had a California meetup group at one point. Like, how can people get in touch with you, and how can they maybe meet you in real life?
Yeah, let me go over where I'm gonna be in the next couple months. First of all, because it is a very busy season, like
Yeah.
September, October is usually very busy. So I'm gonna be at the Passive Income MD, PIMD conference for mostly doctors, physicians in Los Angeles in September, I think 21st and 22nd. I'm gonna be Left Field Investors Conference, which is a kind of investor group
That's
in
what we
Columbus.
modeled our club after, very similar
Oh,
to what
great.
they have, yeah.
Yeah, yeah, they're a great bunch of guys. So I'm gonna be there on October 4th, I think it is, in Columbus.
Mhm,
I'm gonna be in New York at the Lone Star Capital Annual Summit with Rob Beardsley, but I
mhm.
don't remember the dates. I'm sorry
Yep.
offhand. But I'm gonna be there in October. It's in October for sure. That's
Mhm,
in Manhattan, downtown Manhattan. I'm going to be at a conference that's being run by Bronson Hill and Stephanie Boldrini. I forget the name of it. I'm sorry, guys, but it's in October as well. And I'm also forgetting the date because I have this like a whole travel
yeah.
schedule. I'm also going to be presenting at a virtual conference in October that is being put on by, boy,
I put you on the spot here.
yeah,
You've
yeah,
got a
no,
lot of events.
I just looked at his name yesterday. Why am I Joseph Bramante?
Yes,
I don't know the name of the conference, but he has a conference he puts on every year. It's virtual.
for
I'll
the
be on
past
that. Yes,
yeah,
and that's what's coming to mind for October and September. I may be missing one thing.
okay.
As far as how to reach me, easiest way to reach me is definitely my email. I have no website or any social media or anything, but the email you see on the screen, jroll@rollinvestments.com. So JROLL at roll, ROLL investments with an S.com. Easiest way to reach me. Anyone is welcome to reach out to me if there's any way I can help.
Thank you so much, Jeremy. You're so generous with your time, and I always learn something new every time I talk to you or every time I listen to a podcast you've been on or something like that. So I feel like you give a really great perspective to the passive income adventure lifestyle because you're living it. And I think it tends to get over glamorized, and that you're gonna sit on a beach and all this stuff, and I feel like, no, it's it definitely brings a degree of freedom, but there are certainly trade-offs, and what we're trying to do on the show is paint an accurate picture of what passive income lifestyles really do look like, because otherwise it's too easy for people to get just wrapped up in scammy type of things that aren't really real. And the first Ponzi scheme that we were ever invited to become a part of was recommended to me by a good friend who had graduated from the Wharton School. So just being educated does not protect you from these kinds of things. I think just talking to real people living that life, and especially people like you who've been through it, you're not at the beginning of it. You've actually are giving us experience from the trenches of living this lifestyle. So thank you so much for being on the show and talking to our viewer, and please don't be shy about reaching out to Jeremy. The network is how this stuff goes around, and those of us who are on the other side of the screen or the microphone or whatever, the reason we put these podcasts out is because we want to talk to you. We want to be in your network. We want you to be in our network. So please don't feel shy about reaching out to any of us at any time. Book a call. We all have ways to do that, and we're looking forward to talking to you. So thank you again, Jeremy, for being on the show.
Yeah, thanks for everyone for hanging in there, and I hope this was helpful for everyone who watched. Thank you.
It definitely was for me. And if you want to have Jeremy on your podcast, please email him, because you definitely want an hour alone to ask all your selfish questions. All right. Have a great day. Thank you for sticking with us if you're still here. Thank you so much for listening. Those kinds of conversations, I could listen to them all day. I know I talk about how sometimes this kind of stuff can be a little bit on the boring side for people who aren't dealing with it. But if you're in a situation where you're trying to make some investment decisions with large amounts of cash and feeling the responsibility of making good decisions with that and knowing what's at stake, being able to and feeling like you have an abundance of options can sometimes make you feel a little bit more unsure of what to do. And so we're really here to help you out with that. Like I said at the beginning, we may or may not be a right fit for you in your investing and your investing goals. We have a pretty specific and tailored type of but if you are an accredited investor and you want to learn more about what we're doing over in our fund, where we loan money and we also invest in profit sharing types of projects as equity, we give you the option. You can choose each investment individually on our portal. It does require a little bit more due diligence from you up front. So we want to help people who are ready to help themselves. And whether or not that is you, I don't know, but we'd love to have a conversation and find out. So go to our website at Rise Capital CO, or if you want to be a little bit more hands-on, or maybe you're not a accredited investor, you can go to riseclubcapital.com, where we have some different options. We have a weekly meeting where we get together and just hammer out deals. If you would like to reach out to Jeremy, I'm going to put his email on the screen again, jroll@rise.com. And he really does answer emails, and you can easily schedule a call with him. He's been enormously helpful to me over the last couple of years of just checking in with him every so often and just asking him some questions. And he really does love what he's doing. He eats and breathes this stuff because he loves it, not because he has anything to sell, and not because he has any ulterior motive. And I think that that's really rare. But to me, that's the freedom with the passive income lifestyle, is you get to make those choices about how you choose to spend your time and how you choose to spend your money. And so Jeremy really is giving back in one of the most valuable ways possible, giving of his time. So please reach out to both of us after the show. We're really looking forward to hearing from you. And I would love to hear about your next passive income adventure. Until next time.